Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. It's been another fascinating week in the markets, with US stock markets rising and then falling back after the chairman of the Federal Reserve appeared to put something of a damper on hopes of further interest rate cuts following the one made this month. While gold rallied back towards the $4,000 mark after retreating from its earlier peak. The UK market and Japan, notably, were among the markets that ended the week higher than they began. At the same time, gilt yields continued to soften as bond yields came down. In this episode of the Investment Trust podcast, I am going to be taking a slightly different tack from both last week and most weeks by talking to three different managers, all of them operating in the biotech sector. Now, this has been a painful playground for investors, if I can put it that way, over the last 4 years, until earlier this year. Over the last 3 to 6 months, we've seen something of a recovery in the performance of the share prices of biotech stocks and these investment trusts that specialize in that area. It is an interesting area where there are some 7 trusts in all in the broader biotech and healthcare sector. But biotech is where the action has been recently. After 4 years in which they've underperformed the S&P 500, something that's never happened before, biotech stocks have actually moved ahead of the S&P 500 in the last 6 months. So the three trusts I shall be talking to, 2 of them actually date back to the 1990s, those being Biotech Growth Trust and International Biotechnology. And the third is a more recent newcomer, RTW Biotech Opportunities, which IPO'd on the London market in 2019. Those I have on the podcast, all of whom were interviewed separately, are Ailsa Craig, the co-manager of International Biotechnology, market cap some 280 million. Geoffrey Hsu, the long-serving manager of Biotech Growth Trust. He's been working on that particular trust for some 20 years. That has a market cap around 265 million, so very similar. And Woody Stileman, who heads up the London office of RTW Biotech, the managers of the trust of that same name. What follows is a discussion of some of the factors that have driven the recent revival in the biotech sector, and that's where I began my questioning of my guest this week. So my first question to you, Woody, is as follows. We've had a period of what was spectacularly impressive performance from the biotech stocks for a period up to about the end of 2021, and since then we've had an equally impressive period of underperformance. And now we've had a bit of a rally, or quite a decent rally, in fact, it has to be said. Your share's up around a third in the last 3 months alone. So it's been a roller coaster ride. You've been listed since 2019. I wonder if I could just ask you the first question, which is, why have biotech trusts been so out of favour? And then we'll come on to what's changed now.
Yeah, absolutely. Thanks, Jonathan. So over the last several years, biotech itself has been a bit of a bear market. The sector has actually underperformed the S&P 500. It did for 4 years in a row. So if we take the XBI, which is the S&P Biotech Index, this year would have been the 5th year in a row of underperformance. But that in the last few weeks has changed over and it's now outperforming the S&P. If we go back in time, actually, this is a serious anomaly. If you go back in time, before 2022, the XBI had never underperformed the broader S&P index by more than 1 year consecutively. So you can see that that's quite a change of pattern. I think one of the things that clearly has been a headwind, which is now moving to a tailwind, and maybe I can turn the question from what are the things that are changing? So interest rates for many years from 2021 until more recently were a headwind. Biotech companies are generally companies that are developing drugs. It takes a long time and a lot of money to develop those drugs. So it is the definition really of a long duration asset. So interest rates going up is a headwind. After a few rate cuts, we're now seeing that as a tailwind. The next is policy uncertainty. Clearly, developing drugs is sensitive to policy as well. With the Biden administration, there were some policy maneuvers that were perhaps headwinds for the sector. And that really then continued into the Trump administration. And the way that we think about sort of policies really in the last 6 to 12 months has been framed around 3 things really. One is, what does RFK Jr.'s appointment to health secretary mean for the FDA? 2, what are the implications from tariffs? And 3, what does Trump mean when he says that he wants to have a most favored nation clause on drug pricing, i.e. the US should pay less for drugs than it does in UK and Europe? And so we've been navigating through all of those. I think we can safely say that the clouds on policy are now parting too, for reasons that we can get into in a bit. I think the last bit, which is the bit that we're most excited about, is that if we go back to the sort of 2020, 2021 period, when there was great excitement about biotech, I think it was relatively immature at that point. So there was plenty of promise, but at that point, it was very much sort of promise. But what we're seeing now is we're seeing the maturing of that innovation. We're seeing several very successful late stage trials for novel drugs, new modalities, and those sorts of things. And indeed, we're starting to see several of those drugs move into approval and commercialization. So I think the thing that gets us most excited about the change over the last several years is moving from early stage excitement and promise into the sort of maturing innovation and emerging commercialization of these exciting new drugs, therapies, and technologies.
So if we just take that last point, first of all, the other points are also very interesting, of course. In terms of the development, as you say, the maturing of a lot of these early stage high risk research processes and development processes, are things sort of spinning faster than expected, or are they just spinning in a normal traditional way? In other words, is there a lot more going on? You hear people saying there's a lot more tentacles where the research focus is going. Is that actually right, or is it just a question of time doing its work?
Well, we firmly believe that we're in a golden age of innovation within medical care. And I mean, let's just use a couple of examples. Firstly, the obesity drugs. 3, 4, 5 years ago, no one had heard of the obesity, the GLP-1s. Now it's potentially, and actually it will be, the biggest drug class in history. Some analysts expect there to be between 100 and $150 billion of annual sales coming from the obesity drugs. 3 years ago, 4 years ago, that was zero. So that's obviously a very clear example for all to see. Maybe one other one that certainly grabbed global headlines, but a company called Unicure had some amazing data for a gene therapy it has for a disease called Huntington's disease, a genetic disease, and actually it was all over the BBC as well. So it was definitely grabbing global headlines. The data showed that it's a gene therapy, which has had some ups and downs over the last several years, gene therapy has. The data showed that over a 3-year time period, it slowed down the progression of the disease by about 75%, which is a remarkable thing. Really proves the exciting potential now of gene therapies, whereas maybe over the last couple of years, because innovation never goes in a straight line, people were beginning to question it. So I think those would be two pretty clear examples of how this innovation, which is remarkable really across the whole space, has continued to blossom into real potential cures and real drugs that are changing people's lives.
Yes, a friend of mine has been diagnosed with Huntington, so I noticed that announcement. And well, it's a good example of what progress can do. Just to finish this point, though, and of course, you'll expect me to ask this question because I'm sure everybody asks this question. Is this an area where AI is going to make any difference in terms of drug development, in terms of analyzing and then developing new molecules or new drugs from those?
Our view on that is that it could do, but it's too early to tell at this moment in time. The thing about the human body is that we still don't know perfectly what happens when we put a drug inside the human body. That's why we do clinical trials. So, is there potential for AI on therapeutics? Yes, I'm sure there is. Will we get to drug candidates that we can put into clinical trials quicker? Yes. Will we be able to reduce the length of time in clinical trials? Quite possibly. So there is great potential, but rather like the earlier point on maturing innovation, it's probably a little too early for us to tell at this moment in time. And then back to your previous question on why has biotech underperformed? Well, one of the answers that I left off there was that there is an obvious immediate application for AI within biotech, within drug development. That's not to say it won't come in the future, but now there isn't an obvious case for it. And the market tends to like things that are very obvious. And, AI tech is obviously where they've been focused more recently. We do think, though, so when we think about investing, we think about drugs as well as devices, diagnostics. So on the medtech side, we do think that the application of AI to medical devices and diagnostics and those sorts of things is much more clear and present. And we're spending a lot of time thinking about investment opportunities there, i.e., the winners in medtech who are going to be the ones that apply AI to diagnostics or improving the efficacy of devices and so on. So we think there's much more near-term opportunities on the medtech side, but we're still yet to be convinced about exactly what the benefits are on the therapeutic side, but we are hopeful.
So let's go back to RFK Jr., the new head of the health department, or whatever it's called in the US, who has some views about vaccines, which I think are well known. He doesn't like them, and he claims to have a worm in his brain. An interesting character. And his arrival at the scene was, I think, rather feared. And at the same time, we've had new appointments to the FDA. What's your verdict on that so far?
Well, let's be absolutely clear. RFK Jr. and his appointment as a health secretary in the US, he has not broken the FDA. The FDA is still functioning. It's still functioning extremely well. And there's a chance that in the future, it may function even better than it did do in the past and become more efficient through the application of things like AI, replacing animal testing, and different departments within the FDA maybe speaking to each other a bit more than they did in the past. They used to be quite siloed. So, the inverted commas Main Street media might have you think that the FDA is not functioning. We speak to our portfolio companies extremely regularly. The first, second, or third question that we ask for them at the moment is, has there been any change in your dialogue with the FDA? Anything to alert us on there? The answer almost uniformly is no, with a few minor exceptions, but almost uniformly is no. Drug review teams are still in place. There still is a move towards regulatory flexibility, getting drugs to patients that need them as quickly as possible, particularly in areas where there is a high unmet need. We think it's actually quite instructive that on the 21st of June this year over the summer, RFK Jr. tweeted hashtag MABA or MABA. It means Make American Biotech Accelerate. This is an important part of my MAHA movement, my Make America Healthy Again movement. We have the number one biotech life sciences ecosystem in the world. We want to maintain that position. And in order to do that, we need to get drugs to patients that need them quicker and cheaper. I mean, that's music to our ears, really. If you then follow, as you said, there's a new head of the FDA, Marty Makary. We think that he's been extremely transparent about what his plans are with the FDA, the decisions that they're making. And actually, we think with him, the FDA is in pretty good hands. And if RFK Jr. is serious about his MABA agenda, not just his MAHA agenda, then I think US biotech's in a pretty good spot. It's worth noting, actually, that since that moment, since the 21st of June, biotech has massively outperformed the NASDAQ, pretty much any index you care to find.
So that certainly suggests that that's a significant factor, the fact that it's improving the outlook there as far as regulation is concerned. Okay, so let's go on to drug pricing then. I mean, I think it's well known that drug prices in America are much higher than they are in lots of other places around the world, including the UK. And obviously, President Trump has put that near the top of his agenda of something he wants to deal with. So that brings us necessarily onto tariffs and to China and things like that, and trade negotiations. What's happened so far in terms of drug pricing initiatives from the administration, and what's happening in the industry at the moment?
Yeah, sure. So I mentioned earlier that we think about policy in three buckets. We've already talked about the FDA one. The next was pharma tariffs. And then the last one is drug pricing. So I'll come back to drug pricing because it's heading towards resolution, but we're not quite there yet. And for reasons I'll come to in just a second. But on the tariffs aspect, I think we can be fairly confident that that is kind of behind us now. Certainly as relates to biotech. It's always been a bit more of a pharma issue than a biotech issue. Most biotech companies are in clinical development. therefore they're not in commercialization, therefore they're not manufacturing. They can think about where their manufacturing is going to be set up in the future based on what the sort of tariff setup is going to be in the future. So more of a pharma issue than a biotech issue at this moment in time. And pharma seem to be sort of getting to some sort of resolution on this by making huge manufacturing commitments to the US. And that appears to be appeasing the Trump administration in terms of pharmaceutical tariffs. I think it was in July, again, looking at the market reaction, because that's how to tell where people are positioned. If we take July, Trump, you might remember, it was an informal announcement. Trump said that there was going to be 200% tariffs on pharmaceutical products. I immediately thought, oh gosh, what's going to happen to the XBI? I was pleased to see the XBI, the S&P Biotech Index, was up on the news. It was also up 3% the next day. And the reason being is that what he also said is that there'll be a 12 to 18 month moratorium for people to bring manufacturing onshore. So I think with that, we can say that probably the tariff policy risk is now behind us too, alongside the FDA risk. The one outstanding one is what your question was about, was drug pricing. And again, we think that that is heading towards some sort of resolution. We've already seen Pfizer and AstraZeneca come out with deals with the Trump administration that seems to agree with Trump's efforts there. We've always held the view that the worst case scenario of Trump forcing through an act of Congress that would require drug companies to sell drugs in the US at the same price as they do in other similarly developed countries was very, very unlikely. It would be riddled with legal challenges and all those sorts of things, and there probably wasn't much appetite from Congress to do it in the first place. We've always thought that the more likely way that a deal could be done is really twofold. One is prices outside of US go up, and that looks like it's happening. I mean, there have been announcements from sort of government here in the UK that prices are likely to go up. And it's rather like, I mean, I think the metaphor here is defense spending. I mean, Trump has got NATO countries to go from 2% to 5%. Well, in this case, drug pricing, or I should say, spend as a percentage of GDP on new innovative drugs is in the sort of basis points of GDP. It's nothing like 2 to 5%. So can ex-US drug prices go up? Quite possibly, and I think that that's happening. The other way to get drug prices in the US down is by cutting out the middlemen. So in the US, they're called the pharmacy benefit managers, and they're sort of wrapped up with all the insurance players and so on. About 40 bips or 40 cents in every dollar of a drug in the US, about 40 cents of it goes to the middlemen. And for not doing any innovation, just being the sort of conduits to getting drugs to patients. And one of the parts of these deals that Pfizer and AstraZeneca have announced is that there will be a direct-to-consumer pathway for drugs to be sold to consumers, cutting out the middlemen at lower prices. So to your question, drug pricing heading towards a resolution, not 100% there yet, but if the blueprint from Pfizer and AstraZeneca, if that is the blueprint for what future deals are going to look like, then it's
So,
not
in other
going to
words,
be a
as long as
major
the people
issue
who
for
are
the
squeezed are
biotech
the
industry.
middlemen, it's not going to necessarily be a disaster for the kind of companies you're investing in. That's what you're saying, right?
That's right. I think 40 cents in a dollar for middlemen is quite a lot, isn't it, Jonathan?
Well, I don't know. It's always seemed to me been a bit of a scandal for a long time. Okay, so let's talk about your trust now and what actually you're doing. Obviously, you have significant holdings in unlisted private companies as well as public ones. And not until very, very recent have you seen any IPOs of any significance for quite a while as well as part of this sort of drought period in the biotech sector. Is that actually changing? And if so, where can that take us? And how will that benefit your portfolio, as I say, with your significant private holdings?
Yeah. Why don't I just take a couple of steps back and we'll come to that? Because we have about 30% in private. So it's material, but not vast in the sense that 70% is obviously publicly listed. But we are specialist healthcare investors focused on innovative biotech and medtech companies. We invest in, we develop ourselves, and we finance companies that are developing and commercializing really life-changing drugs, therapies, and technologies. We are what we call global science-led full life cycle investors. Global obviously speaks for itself. We are headquartered in New York. I run our London office, but we have offices in Asia too. So we look for assets wherever they are in the world. Science-led means that really everything at RTW starts with the science. I mean, there are about 80 of us in total, about 40 on the investment team, and about 20 of those are PhDs and MDs. So our edge really lies there, or the core of our edge lies there, is better handicapping the chances of a drug successfully navigating clinical trials and early commercialization based on our deep understanding of the science. And then the last bit, which goes to your question, is that full life cycle aspect. So we are public-private investors. We invest from what we might say from lab to jab, or from creation to commercialization, and really everything in between. As I say, about a third of that currently is invested in private companies. If we then break that down further, about a third of that, one third, is invested in company creations, companies that we start ourselves. But 2/3 of that is invested in late stage private companies where we are looking for IPOs within the next 12, 18 months or so on. But you're right to say that there has been a bit of an IPO winter. There have been a few IPOs that have gotten out this year, particularly earlier this year, and a few that are coming out now. So it looks like the winter is thawing, but there's still maybe some way to go. That doesn't particularly bother us because actually the opportunity on the public side is so unbelievably attractive right now that that's really where we're focused for new investments. Clearly IPOs are not the only exits or liquidities for our private assets. We actually had a position called Alcyone. It's in our private portfolio that was taken out by Biogen a few weeks ago, is going to be taken out by Biogen. It's worth noting that the deal value was only a small deal, but it was about a 250% premium to our holding value. So whilst IPOs are the normal conduit for us to realize the value of our private portfolio and get them into the public portfolio, it's not the only way. In fact, in the last 18 months, that is the second private position that we've had taken out. The other one was a company called NewMab. It was acquired by Johnson & Johnson. If I remember correctly, it was about a 180% premium to our holding value. So IPOs are important, but they're not the only thing. And we think the opportunity set in publics right now is really very exciting. And most of our portfolio is invested on the public side, actually.
I mean, there has been a significant pickup in M&A, as you say, in the last few weeks. That's been very noticeable across the sector. So let's look at the trust then. Obviously, good news, you've been promoted to the all-share index, FTSE all-share index, so that must have helped liquidity, you would think. But your discount remains wider than some of the other players in the sector. It has come in significantly, but it's still wider than the average. Why do you think that is? Is there something that you're doing that is holding the discount coming in further? Private holdings may be a factor in that as well. How do you interpret what's been happening to the discount as far as RTW is concerned?
Well, I mean, we have traded at a premium in the past, and we fully hope that we'll get back to trading at a premium. It does clearly disappoint us that we're trading at the sort of mid-20s discount to NAV. I think that largely reflects, albeit we think maybe incorrectly, it largely reflects the private holdings. If we look at our direct peers in the sort of healthcare biotech listed investment company investment trust space, the one that's trading at the steepest discount to NAV has the highest private exposure. And the ones that are a small group that have very little private exposure trade at a narrower discount. As we look at ourselves, I mean, I've demonstrated, I think, hopefully in my answer to the last question, that there's significant embedded value within our private portfolio. I've just given two examples, but I'll maybe just give you a couple more. I mean, two of our biggest private positions are two obesity companies, one called Corcell and one called Kylera. Kylera just did a financing round at a 40% step up to the prior round that we participated in, a fantastic syndicate. It's led by a CEO called Ron Renaud. He's a bit of a rock star in biotech. He's successfully sold 3 or maybe 4 biotech companies to large pharma companies for multiple billions of dollars. So that alongside Corcell, as I say, another of our obesity private companies, we think very significant embedded value within our private portfolio. So, I think for us, we just need to continue to get that message out to investors, the embedded value there. You may ask, what are we doing with capital or any cash that we get from M&A? As you may know, we do have a capital allocation policy in place. Just taking a couple of steps back, our mandate is for long-term capital appreciation. And we have a 16-year track record of doing that very handsomely on our private funds. we now have a 6-year track record of nearly low teen returns in our listed fund, RTW Bio. That's index beating and peer leading, handsomely index beating, I'd say, and peer leading, despite the fact that half of that time has been in this dreadful bear market for biotech that we talked about. We frankly fancy the fact that the next 6 to 10 years will be even better than what we've done over the last 6 years for reasons that we can discuss further and have touched on already. And because of that, there's more opportunities than there is capital. It's also important to acknowledge, though, that biotech companies need cash to develop through the clinical trials. They're not companies that throw off cash. So one needs to be cognizant of that when one's thinking about allocating capital. But as I say, we do have a capital allocation plan in place. And what we've said is that when we are in receipt of material cash inflows, we will consider returning a portion of that to shareholders through NAV accretive share buybacks. Now, we actually just increased the share buyback budget by a further 15 million just the other day after one of our portfolio companies was taken out, a company called Acaro. It was taken out by Novo. But that was also hot on the foot of a few other takeouts. One was a company called Verona, another Maris and Alcyone, which we've already mentioned. And that's before we've just had another takeout recently from a company called Avidity. That 15 million increase in the buyback was before that deal took place. So where there is cash coming in, we will use it to do NAV accretive buybacks. But important one last point is that we do eat our own cooking at RTW. So our CIO and founder, Rod Wong, he's bought a lot of shares. RTW are his initials, by the way. He's bought a lot of shares in the open market over the last 12 to 18 months. And combined, RTW management, partners and employees own over 15% of RTW Biotech Opportunities. And pleased to say that our non-exec boards also have decent stakes that they've bought in the market too. So they definitely back what we're doing.
So I noticed in your recent announcement you said you repurchased 15% of all the shares traded during the period in the first half of 2025, and that followed another significant buybacks last year. The argument around buybacks is often couched in terms of, well, if you can get an instant return from a buyback that is greater than the amount you can get from new investments, then blah, 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 it looks better to do that. But if you're right about the outlook for biotech now rebounding from this dry period, then might there be a case for saying that using it for buybacks is actually not the best use? If you carry on growing it, the share price is performing as well as it is over the last few weeks, reflecting underlying value. What would you say to that?
Well, look, I think that is why we think about it through a capital allocation framework as opposed to, let's say, a sort of blunt discount control mechanism or something like that. One has to evaluate the opportunities as you see them and think of it in that sort of framework as opposed to just buying for the sake of it. So, yeah, we will constantly evaluate the potential to make new investments versus ongoing buybacks.
Not very recently, you did a deal involving a company called Arix. What was the logic behind that? And are you actually still looking for other opportunities to grow the size of the business and the size of the portfolio by means of making other acquisitions yourself? Obviously, quite difficult when you're trading at a 25% discount. That's true. But you can do it through other types of fund as well, of course.
Yeah, look, I mean, we want RTW Bio to be the sort of flagship biotech vehicle on the London Stock Exchange for people to participate in the amazing innovation that we see in biotech. In order to do that, one needs scale, one needs a good brand and all those sorts of things. And one of the ways that one can do that is through acquisition, obviously. Arix was a perfect target really for us in the sense that its mandate overlapped almost exactly with our own, as in it had some public investments, it had some private investments. Two, it was trading at a very, very steep discount to NAV, so there was an opportunity for a deal to be done. And then three, it also had a huge amount of cash on its balance sheet. So we could use that cash at what we felt was a very, very opportune time in the biotech sector, in the biotech market, i.e. near the lows. So we wouldn't discount the possibility of doing deals again in the future. That was a perfect fit for us. So if there were attractive deals like Arix to be done, then we would certainly look at it.
Final question then. We know that biotech investing is a high risk, high reward type of business, type of thing to invest in. And obviously, you've given lots of reasons why to be positive at the moment, but what are the biggest risks that you think you're facing out there? What could go wrong with this very rosy outlook that suddenly people seem to be talking about as far as biotech is concerned?
Well, the good news is that valuations are attractive. So the asymmetry of risk versus reward is pretty low on the risk side and pretty high on the positive side. That's not to say that it's not a volatile sector. It is obviously sensitive to policy. It's obviously sensitive to interest rates, and innovation never goes in a straight line. So there will be ups and downs along the way. But I think looking at China is actually instructive. If you go back 18 months ago and you put the words China and biotech in the same sentence, people would run out of the room. Now, if you put China and biotech in the same sentence, people want to talk to you. And people are now aware of what's going on in China from an innovation perspective. The biotech portion of the Hang Seng Index is up well over 150% year to date. And it just shows that when sentiment is so far the other way, it only takes quite a small shift for valuations to change quite dramatically to the upside. And so, yeah, innovation is never in a straight line. It is interest rate sensitive. It is sensitive to policy. But given where valuations are at the moment, given where sentiment is, given where positioning is, in our view, downside is relatively low and the upside is obviously extremely exciting.
Okay, so that's a very good point to stop. Thank you so much. Very interesting and instructive. And, well, I hope your confidence is justified. I'm sure it will be.
Thanks, Jonathan.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Next up, I talked to Geoffrey Hsu, who has been the manager of the Biotech Growth Trust for a long time now, actually, for something like 20 years, I think it is, getting on for. So you've seen the cycle go up and down a lot over that period of time. What is your explanation for why we've now seen, after a very long 3-4 year period of underperformance by the biotech sector and widening discounts and so on, what do you think is the main reason behind this resurgence in share prices that we've seen in the last 3-4 months in particular?
So you're absolutely right, Jonathan. We had a record period of underperformance in the biotech sector really since 2021. I can't overemphasize the fact that how unprecedented this really was. It was unprecedented in its duration. It was unprecedented in its severity. It was unprecedented in terms of relative underperformance versus the S&P 500. In fact, if you look at the performance of small cap biotech in particular, as captured by the Russell 2000 Biotech Index, since March 31st, 2021 to September 30th, 2025, that index underperformed the S&P 500 by 116%. So record underperformance versus the S&P 500. And I think what people are now realizing and why we've had a resurgence over the past 6 months is the fact that absolute valuations have just gotten so low for the sector. We have a large number of companies that are actually trading at market caps below the net cash that they have on their balance sheet. And what I think has triggered the resurgence is, number one, the Fed has recently entered another rate cutting cycle. So one of the principal reasons why the sector did sell off in 2021 was because of an anticipation that the Fed would need to raise interest rates rather dramatically to tame inflation in the United States, and that policy has largely been successful. Inflation has basically come down in the US since the highs of mid-2022. But fortunately, we're now in an interest rate cutting cycle. The Fed cut interest rates last month. They cut interest rates again this week. And hopefully going into 2026, if those rate cuts continue, that would be a nice tailwind for the sector. The reason why interest rates are important for the sector is not because these companies take on a lot of debt, but it's really because the risk-free rate, especially the 10-year government yield, is an important component of the discount rate we use to value these companies. When we build a DCF on these companies, we have to discount the future cash flows, of course, today. And obviously, the higher the risk-free rate, the more we have to discount those cash flows. The second thing I would say is we have had a strong year of M&A activity in the sector. Just this month, in fact, 2 portfolio positions in the Biotech Growth Trust were taken out. Akira was bought by Novo Nordisk, and a company called Avidity was bought by Novartis. So one of the main investment themes for the sector is the fact that we do expect M&A activity to accelerate over the coming months. And that's because a lot of the blockbuster drugs that are currently sold by Big Pharma are due to lose patent protection before 2030. So these companies obviously have to acquire biotech companies in order to offset that revenue shortfall that they're expecting in the coming years. And I guess the third aspect that I think has really triggered a recent recovery in biotech is the fact that a lot of the political uncertainties that really weighed on the sector earlier this year are abating. So the FDA, as part of Trump's broad budget cuts across the government, also suffered some budget cuts. Many investors were very concerned that this would slow down the pace of drug approvals. But what we've observed so far is that the pace of drug approvals has not slowed down at all. And in fact, the FDA Commissioner, Marty Makary, is very keen on accelerating drug approvals and getting these important medicines to the market as soon as possible. There's also some concern about Trump's executive order, where he talked about instituting most favored nation pricing for drugs in the United States. He's very upset that the Europeans pay a lot less for their drugs than consumers in the United States, and he wants those prices equalized. But interestingly, number one, we think that type of MFN provision really to have teeth would have to be passed by Congress. We think that's very unlikely to happen. But number two, more importantly, Pfizer just recently announced a deal with the Trump administration saying that they would be willing to offer most favored nation pricing for their Medicaid business, and as well as some very compelling pricing on Trump's new website, TrumpRx, where Pfizer would basically sell drugs directly to consumers at a heavily discounted price. That deal basically allowed Trump to have a headline win where he can say to the electorate, I'm lowering drug pricing, doing something about drug pricing. But in fact, if you look at the P&L impact of Pfizer, it's actually very, very minimal. So it's not actually going to adversely impact Pfizer's earnings profile going forward. So that deal, I think, provides a nice template for other large pharmaceutical companies to make a similar announcement and basically get past this issue. And in fact, AstraZeneca followed shortly thereafter with a similar deal of their own. So we do expect a parade of large pharma companies over the coming weeks to sign similar deals with the Trump administration. So I think the drug pricing risk is kind of disappearing into the background. The budget cuts really haven't had an impact on drug approvals. And then the one other main issue really is the appointment of Robert F. Kennedy as the head of the Department of Health and Human Services. He's a noted vaccine skeptic. A lot of people were very concerned that maybe the FDA was going to become less science-based going forward. I would admit that vaccine development, I think, is really tricky right now, simply because we don't know what types of policies RFK might impose with regards to vaccine development. And in fact, we sold all of our vaccine portfolio positions once that appointment was made. But I would say that that has not affected in any way drug approvals. So if you're looking at classic drugs, non-vaccine therapeutics, that has not been affected in any way. And in fact, again, as I mentioned earlier, the FDA commissioner is very keen on actually accelerating approvals for a lot of those drugs.
So it sounds like a lot of good things are coming together, and we can see that in the share price movements over the last few months, as you say. But we're still quite a long way before we get back to those heady days in the past. What do you think is going to drive the next phase of it, therefore? Is it going to be more M&A? If these policy uncertainties are disappearing, is it we're actually going to see the big corporates come out in bigger numbers? They've got the patent cliff to deal with. So how close to a sort of slam dunk is that? Is that going to be the driver of the performance of some of these companies in which we're investing?
So one thing I'd like to emphasize is that the unprecedented drawdown that we saw starting in 2021 was really disconnected from the fundamentals of the biotech industry. The fundamentals of the biotech industry in terms of the innovation that's taking place is very, very strong right now. So just to give one example, there's a company called Unicure. It's a gene therapy company. They recently announced results for their gene therapy AMT-130 in a rare genetic disease called Huntington's disease. And it showed that this particular therapy can slow the progression of this disease by 75% over a 3-year time period. This is an unprecedented result, completely novel mechanism of action. And it's just an illustration of the type of great science that's being conducted in the sector right now, type of innovation that's happening. And ultimately, this innovation creates value. So I think the recovery is really going to be based on a few different pillars. Continued M&A activity, as you mentioned. Interest rate cuts is going to help to sort of the macro environment for the sector. The abating political headwinds, I think, are going to help as well. But ultimately, it's really the core innovation that's taking place in the sector. And we really think the sector is really in a good spot there. One thing I'd also add is that the regulatory environment has been very positive for the approval of new drugs over the past 8 years. And it seems like actually this Trump administration is very excited about accelerating and shortening the drug development timelines even further. So I think there's the prospect of approvals even accelerating over the next few years. So that's also going to drive up share prices in our view.
One of the reasons it took so long in the past was concerns about the side effects and so on before you can test these things fully. There must be a risk. The last thing you'd want would be a nasty case where something actually proves to be damaging rather than helpful. Is that a real risk or not? The faster you accelerate the pipeline?
Sure. So I think there are ways to accelerate the development process without obviously rushing into things and maybe approving drugs prematurely when the safety profile has not been completely elucidated. So one example of a policy that the FDA has recently put out actually is to reduce the animal testing requirements necessary in order to get a drug approved. So rather than going through these cumbersome animal tests with regards to testing for toxicity for these particular drugs, maybe some of that actually can be done through in vitro models, through cell models, through artificial intelligence driven models, and so forth. So that's one way in which you can reduce the drug development time, but still get a good bead on what the safety of the compound might be. So I think the large scale human clinical trials still very much will be necessary and important to do in order to really elucidate the risk benefit profile of these drugs. But I do think there are some expedited steps that one can take earlier on in the drug development process that will help speed things along.
Well, let's talk about your specific trust, the Biotech Growth Trust. What is it that's distinctive about your trust compared to some of the others? You've got some very good competitors out there in the sector. You're not the largest, but you're not the smallest. How do you see your position inside the investment trust sector as far as biotech is concerned? And what is a particular selling points that you would be pushing at the moment?
So I think our fund has a number of distinguishing characteristics. First off, I work for an organization called OrbiMed. I'm a general partner here. I've been in the firm for the past 20 plus years. And we are a global healthcare dedicated investment firm with over 25 years of experience investing solely in the healthcare sector. So we have a lot of experience investing in biotech in particular. I co-manage this trust with my colleague, Josh Gollum, who's also a partner at OrbiMed, and both of us have over 20 years of experience investing in biotech. Secondly, we are a rather large organization. So total assets under management at OrbiMed is roughly $19 billion. And we have a number of business lines. So it's not just public equity investing that we do. We also have a very robust venture capital business. We have an Asia venture capital business. We have a royalty and structured debt business as well. And in particular, with regards to our venture capital business, the activity there actually helps inform a lot of our public equity investing in that we get an early look, if you will, at IPOs that might be coming down the pipeline. This trust has historically invested in what's called the crossover round. This is the last private round prior to an IPO, and we get excellent deal flow on crossover opportunities because of our very strong venture capital business. And they obviously do diligence on a lot of the companies in the private sphere and a lot of the competitive intelligence. So these private companies may compete with some of the publicly traded biotech companies out there. We get a lot of advantage in knowing better the competitive landscape because of the diligence they've done on the private side. So that I think is another distinguishing characteristic of our organization. And then I think we have a true global footprint. So we do have 148 employees worldwide. We have offices around the world, including in Shanghai, Hong Kong, Mumbai, London, San Francisco, etc. And that does give us, I think, an advantage in investing in the very best biotech opportunities in the world. And we do have a global mandate in this fund. It's not just a US fund. We're charged with the assignment of finding the best biotech opportunities globally. So, for example, China is rising as a power in biotech innovation. I think we're distinctive in that we actually have three analysts locally based out of our Shanghai and Hong Kong offices who can do direct diligence on the companies in China and hopefully pick some very successful investments there. So China actually has done quite well so far year to date as well. So I think that's another distinguishing characteristic. I think a lot of other money managers probably don't have local staff on the ground in China in particular.
Yeah, I'm going to ask you about China because it is obviously an area that people are talking about. They have got a strategic plan to grow their biotech industry. What sectors are they actually focusing on? What are you invested in there? And why are you doing that? Why these particular companies?
So, just to give some context, China announced in 2015 that it wanted to make developing a domestic biotech industry a priority for the government. And they did so as part of their 10-year Made in China 2025 plan. With that explicit government support, in fact, over the past 10 years, China's domestic biotech industry has actually blossomed quite a bit to the point, actually, that we believe Chinese companies' R&D capabilities are now on par and in some cases better than their US peers. Just to throw out a metric here, if you just look at the percent market share of clinical trial activity worldwide for the biopharmaceutical sector, Chinese companies actually account for 30% of new clinical trial starts right now. That's above the 21% market share that Europe has. And it is rapidly approaching actually the US market share of 35%. So China, if you think about it, now accounts for roughly a third of clinical trial activity in the biotech arena. And that's really a dramatic change that we've seen over the past 10 years. Now, why is that? Well, one significant advantage that they have is they can conduct clinical trials faster and cheaper than their Western counterparts. And that does shorten development times. And so many big pharma companies in the West have noticed this and have actually begun in licensing promising innovative assets from Chinese biotech companies to develop them in the US and Europe. So a new business model, if you will, is rapidly emerging where if you can do your early stage clinical trials in China faster and cheaper than in the United States, why not do that? Test the drug in China, get some quick proof of concept data to make sure that the drug works. And then for the registration phase 3 trials, where you want to still conduct those in the US and Europe with US and European patients in order to get approval, you would still do that, the large scale trials in the US and Europe. So that's kind of the paradigm that's emerging. And so we are focused in terms of our Chinese investments in looking for great biotech companies in China that have innovative assets, best in class assets, first in class drugs that we think a big pharma company in the US might find very attractive and might pay up for to get US or European rights. So that business development activity, I think, is an important aspect of the investment thesis in China. And we have participated, for example, in a couple of IPOs recently, one company called GenFleet, another company called Leeds Biolab, where we think they have some very, very interesting assets. And those IPOs have actually done quite well year to date.
So regarding the trust again, just quickly, you've obviously bought back a lot of your shares. I think something like a quarter of the shares count in 2025. Are you actually seeing more demand though coming through now? The discount has come into around 8%. Are you actually seeing more investors wanting to come on board?
So as typically happens, strong performance does beget interest from investors. I would say that with regards to the buyback of shares, we do have a discount protection mechanism where we really want to get the discount into the single digit percent range. As you know, most investment trusts out there do trade at a discount. So this is a structural aspect for the closed-end investment trust industry as a whole. But we are committed to the discount protection policy. We have been implementing it. But hopefully, as people recognize that things are starting to turn around in biotech after a very long wait, admittedly, we should get more investor interest in the trust.
And so by implication, therefore, you would say as a portfolio manager that you can see potential returns from where you can commit money today that would perhaps exceed the return you get by buying back the shares. Would that be something I could hold you to saying?
Yes, yes. I think despite the strong performance over the past 6 months, there's quite a bit of upside left in terms of recovery in biotech.
So moving on then, I talk next to Ailsa Craig, who is the co-manager of International Biotechnology, a trust which he's been involved in the management of for getting on for 20 years, will be 20 years next year, I think. So another seasoned veteran in the biotechnology sphere, and one who's had to navigate the ups and downs of the cycle more than once. So, general question which I have put to the others as well, Ailsa, is just remind us why biotech has had such a poor recent performance after having had a very strong performance before that, and why that might now be changing.
So basically, the sector, as you said, does go in and out of favour and has done over the past 2 to 3 decades. This isn't something that would be a surprise to anyone who follows biotech, but you're right to say this particular bear market feels longer than normal. And the way we describe this to our shareholders is that it's received 3 punches, if you like. The first was driven by bubbly like valuations during COVID. So there was a correction in terms of coming out of that and having sort of devaluations of these bubbly valuations. And then the interest rates rose. So that was the second punch, driven by rising inflation. And when you think about how biotech works, it tends to be cash flows received in the future, say 10 years' time. And when you discount back those cash flows at a higher interest rate, you're going to get to a lower valuation. So whilst we were going through that rising interest rate environment, valuations maintained sort of a steady state at this sell-off after COVID. And then the third punch, which you'll all be familiar with, was politics, really. So everyone was excited going into the news that Trump had won the election, primarily because when he was last in power, biotech did very well. He's considered industry friendly. The Republican Party are considered industry friendly. And so the sector started to recover. However, his appointment at the head of HHS in the US, so the Health and Human Services Department, was highly controversial, RFK. And he then made some controversial appointments within the regulator, the FDA. DOGE announced quite a lot of cuts within various different departments like the NIH, National Institute of Health, and the FDA, the Food and Drug Administration. So, if you like, that was the third punch. And that happened around the same time as Liberation Day, when all equities were hit by news of tariffs. So, although pharma biotech absolutely is affected by tariffs, it was a bit of a double whammy with this other political appointments and cuts at the various different departments. So, we had those 3 punches. However, since then, the fear over the regulator changes and tariffs has definitely lessened. And then when you superimpose on top of that, this huge wave of M&A we're seeing, and we think this will continue, excitement has come back to the sector. And we're hearing more and more from sell-side analysts over in the US that generalists are picking up the phone again. So I think after this long protracted bear market driven by those 3 reasons, we're coming out the other side.
Right. And how have you been handling this particular period? Obviously, discounts across the investment trust sector have widened generally, but you have also had to deal with other issues that have affected the investment trust world. So, how have you actually managed your way through this in terms of what you've been doing in the portfolio? And obviously, we'll go on to talk about what's changed since then, and in particular, this M&A activity, which seems to have, should we say, favoured your portfolio quite significantly.
Yeah, so if you take a step back, our strategy at IBT is that we manage the fund in a top-down basis and a bottom-up stock picking basis. So back in 21, when Marek and I took over as lead fund managers, we felt that the sector was looking bubbly in valuations. So we tilted the fund into later stage profitable names, which there are many of in this sector over in the US. And in that way, we preserved capital as we saw this sell-off due to interest rates rising and the valuations coming down a bit coming out of COVID. So that helped us in the sort of 3 to 5 year time horizon. And then as valuations looked a lot more attractive in the era of 22, 23, we did the opposite of that. So we moved the fund back into sort of mid-cap, slightly earlier stage companies. Many of them are profitable or making revenue still, but we certainly came out of the real mega cap companies. And then on top of that, in April, Liberation Day period, we managed to recognize the fear and increased our gearing to the highest level it was actually since Bear Stearns blew up in 2008. So we really felt bullish back in April, and we have this ability, being a closed-ended fund, to gear up. And then since then, like you said, We've had 9 acquisitions out of the fund this calendar year so far. We're obviously just at the end of October now, and maybe more will come. So all of those factors has meant we've benefited, our shareholders have benefited from incredibly strong performance. And we've managed to outperform our benchmark over 1, 3, 5, and 10 years as a result.
I guess we could say that's a demonstration of using the attractions of the investment trust structure. If you can read the cycle to maximize your performance coming out of a cycle downturn, that would be fair. I mean, you mentioned gearing. You have got the best performance over the last 12 months, that's for sure, amongst your sector peers. Generally speaking, though, the question I've asked the others as well is how do you distinguish what you're doing from what some of the peer group is doing? In terms of, if you come and look at the 3 trusts that we talked to today, that's yourself, RTW, and Biotech Growth Trust, what are you doing that's different from what they're doing, and what philosophy is driving that?
So I think what we bring to the table that slightly differentiates us is Marek has actual industry on the ground experience and knowledge. So he used to work in business development. And I don't think that's a coincidence as to why we've managed to find these companies that pharma's also interested in acquiring. So that is a differentiating factor. Separately, we have got venture exposure in our fund. The board want us to have between 5 to 15%, so like a sweetener, a kicker to performance, but not to go too high. And we like that and agree with that because it means that when the sector does recover in the quoted markets, you can really be exposed to that. And we have that sort of exposure right now, sort of around 90% of the fund is exposed to quoted biotech companies. So I think that, and separately on a bottom-up perspective, we don't just back one horse and hold for the long term. What we do is we have a basket approach. So we'll look at a disease area, and instead of just buying one company that we think is the best, we will buy a selection of companies and follow them all. And as and when they read data out, we can sell the losers in our view and back the winners. And that way, we've managed to capture performance in a bucket. So if you have an acquisition within a particular disease area, all of the companies tend to go up on the back of that news. So I think we've managed to capture some sort of alpha on that as well. And like you said, we do use gearing very actively. And I think that's definitely helped our performance. And then separate to that, we don't like to have big positions going into what we call binary events. We think preserving capital is key. And the way we're positioned at the moment is that we think the most exciting area are companies that are either just launched or on the cusp of launching. And we think that because pharma are in real trouble at the moment with IP expiries. And these guys potentially could give them the revenues that they're going to lose when their patents go off. So we've put about a third of the fund versus our index, which is only 7% of the fund and these names, in these kind of cusp launch companies. And 60% of the fund are in clinically de-risked assets. So they've got through the clinic and all they need to do now is get through the regulator, or they've already got through the regulator and launched.
We know that President Trump is very keen to get drug prices down in the US. Is that going to have an impact on the kind of companies that you're investing in? They wouldn't be directly affected, of course, in the short term because most of their drugs are not yet in production. But would you expect that to the extent that it bears down on big pharma's cash flows, that may have a knock-on impact on their ability to buy up more biotech companies as they mature?
Even in your question, you can tell just how multifactorial this is. And we're still gleaning what this will mean for both big pharma companies and biotech companies, as and when we see these deals that the big guys are making with Trump. So it's very difficult to know exactly how this is going to play out. However, I would say to your point, if pharma companies are hit by the tariff issue, it seems to be that it's actually a lot less than people had originally feared. When you look at the exposure in sell-side notes, the pharma, AstraZeneca and Pfizer, et cetera, that we've seen deals struck, it doesn't seem like it's going to hit their top line to a dramatic extent. However, you're right. It would mean less cash to be able to do M&A by definition. So we'll have to wait and see how that plays out. Equally, it does seem like they're doing deals. So if they were to open up manufacturing plants in the US, they might get relief from tariffs for a certain amount of time. So, it's a bit of a wait and see approach. Certainly the sentiment's improved a great deal. We're seeing that in the recovery of the healthcare index, actually, when Pfizer struck the first deal. So I think a lot of these fears are abating. Ultimately, does it affect biotech? Maybe not imminently. Let's wait and see. But it's another reason why we've moved our fund into more rare diseases, because the price differential between Europe and US isn't actually that great. We think that what he's doing is he's approaching the midterms. He's aware that, for example, the GLP-1 class is going to be huge and incredibly successful for those companies involved. And he wants to bring specific prices down in that space. So he's constantly talking about the fat shot as an area for either bringing prices down in the US or putting prices up in Europe, or both at the same time. So I think he's trying to drill into specific drugs rather than having broad brush approach, but we'll have to wait and see.
Let me ask you about another aspect of a trend that you've highlighted, which is, I think, interesting. The percentage of new drugs that are coming from biotech originally, there's been a kind of change there, has there not, over time, compared to how many drugs are coming out of the big pharma companies?
Yes, absolutely. So this has been mentioned in our investor presentation for about a year, 2 years, in that if you look at the proportion of new drugs coming onto the market, 10 years ago, it was approximately 75% from pharma internal R&D departments. And then last year, it was the inverse of that. So 75% of new drugs coming from biotech companies. And the trend looks like it will continue. It makes sense. You can't force innovation. Innovation tends to emerge out of universities. They then get seed capital, then they're IPO on the stock market, and then often they're picked up if they're successful. So that's sort of the evolution of how new drugs are really coming about. And pharma have recognized that and it's taken a step back, maybe done cost cutting in that department and really focused on what they're good at. And what they're good at is having cash capacity to buy up successful drugs that have been de-risked, and also marketing and distribution and global networks of distribution, etc. So they're sort of focusing on what they're good at, and biotech's filling that void.
This cycle, what impact has it had on the biotech industry itself? Obviously, there had to be some cutbacks and so on during this period, but are we still seeing coming out of US and elsewhere a lot of activity that's going to drive the growth, that's going to produce these new drugs? Is there any sign of that either decelerating or accelerating?
Well, the number of new drugs being proved each year absolutely is reaching record highs. So there's still innovation going on over time. So there's plenty of companies out there that could help pharma with their IP predicament that they're in at the moment over time. So absolutely the supply is still there. And we're constantly looking at new companies emerging out of the earlier stage area that could help on that front. Another point, and what we're doing at IBT, which is slightly different maybe to others, is that we recognize that over the past, say, 5 years, where we've seen a bit of a glut of M&A in this sector, the cause of that is that many biotech companies are going to launch on their own independently, whereas before they might have had to have had a partner with cash and marketing muscle to do that launch. And we're calling this space, this area, Biotech 2.0. So 10, 15 years ago, many companies did this in biotech, and that's why you see the Gileads and Amgens and the Regenerons that we have today. And we think we're going to have a second generation of biotech companies that will stand on their own. Some will get picked up, I'm sure, but we like the idea of being positioned and giving our shareholders access to this new wave of potential profitable biotech companies.
Why would they be able to survive then if there's a lot of predators around? What's distinctive about them? What encourages them to do it? Just the access to cash? Is that what you're saying?
Absolutely. They're well funded. So good quality companies. And if you even look over the last 4 or 5 year bear market, have been funded by shareholders. They've not struggled with funding. What's struggling is the IPO market. So that absolutely closed. That window closed over the 22, 23 up until now, really, period. But mature companies with solid, strong, high quality assets have managed to get funding. And another interesting shift is the move into rare diseases. So we've actually tilted our fund quite significantly into rare diseases. And the advantage of that space is you don't need much money to launch a drug because there are so few patients. You only need, say, 30 to 50 reps. And equally, because there are few patients, you don't need great big manufacturing capacity like you'd have to see with the obesity drugs, for example. So all of those factors play a role in the fact that we think we're going to see this next generation of emerging healthcare growth type companies.
Another topic that seems to be getting a lot of coverage is the emergence of China as a significant player in the biotech business. How are you playing that particular theme, or to what extent are you playing that particular theme?
We are absolutely following what's going on in China. It's still very early stage and quite dominated by Me Too type drugs. So the innovation is generally coming from the US. However, that is changing and it is shifting. So we're following that very closely. What we are aware of, though, is that the innovation, new kind of compounds and targets and technologies is still dominated by the US. Successful Chinese companies tend to list on NASDAQ. So we have a number of those companies in the fund, and it adds a layer of transparency in that they have to follow the rules and regs of SEC, etc., when you list on NASDAQ. So it gives us that sort of comfort. So we think over time this will change. They will move up the clinical trial stages, and I'm sure we'll begin competing with the names in the area we're invested in, which is a bit more later stage. But the earlier stage companies, so super early venture type names, they're really seeing the competition at that level. What we've seen with the M&A is that's really been dominated by US biotech companies. Generally, the deals that we're seeing over in China have been licensing deals. So we're keeping definitely an eye on this space, but we still think there's better value right now in US biotech.
Looking again at you as an investment trust, what is the best use of capital for the trust at the moment? Obviously, there's a big issue around discounts and buybacks and so on. What do you think is the best use of capital given where you are in terms of valuations and opportunities and also the size of the discount?
So we're just shy under 10% discount, and it's been relatively consistent with IBT over the past few years at that sort of level. It's the board decision as to whether to buy back stock. But because obviously we are at a discount, then it does make sense that we buy back our own fund with the capital. And we haven't been doing huge buybacks in the way that we've seen some of our competitors do. So that's been beneficial in that sense. And we do also have a dividend that comes out of capital. But with the growth we're seeing with the underlying sector, and then maybe more interest from generalists and wealth managers, hopefully we can bring that discount in and start issuing shares again.
Right, and that would remain as a target. What would you do with it if you could issue shares? What would be the uses you put it to? Any new capital you could bring in?
Well, it would be invested into this sector, which we think is on the cusp of recovery.
Okay, so if we look over the course of the cycles that you've worked through, biotech is a high risk, high reward business. What sort of returns do you think the trust is capable of looking ahead? I'm not looking for specific forecasts, just in general terms, given where you are in terms of valuations and the state of the sector at the moment, which obviously looks like it could well be recovering. What sort of returns do you think the trust is capable of?
Yeah, so longer term, the broad high level view of returns from equities has been sort of 6-7% a year. And then healthcare would be 8-9%. And biotech tended to be low double digit returns per annum. And then if you outperform, which is what we're paid to do, we hope to kind of add on top of that on an average over the long term. So we would expect that sort of ilk of returns going forward if the history were to repeat itself.
And from your perspective, then, how would you sum up where we are in the cycle? I mean, you talked about the exceptionally bad period we've been through. Does that encourage you to think that we're going to enter an exceptionally good period from here?
Well, we think so, actually. It's been a very long, protracted bear market. Valuations in the companies that we're looking at and following are incredibly attractive. We've had a recovery in the last sort of 2 or 3 months that has been quite significant, but off a very low in April. The multiples, so the way we value these companies is price to sales basis. And pharma, and this goes back to Marek's day in business development in biotech, pharma tends to pay between 5 to 10 times peak sales. That tends to be the trend. And the names that we're invested in are sort of 1 to 3 times peak sales. So it's looking incredibly attractive in our view.
Okay, so final point perhaps I can put to you is that obviously you've moved from where you were to Schroders now as a management. Has that made any difference? And if so, what has been the difference that you've noticed? Obviously, part of that was because the private business you were involved with before is going in a different direction now.
Yes, SV Health Investors, our previous home, wanted to focus on just venture and spin off this one public investment vehicle that they had, IBT. This happened in 2023, and we moved to Schroders. What we wanted from Schroders, and it was a unanimous decision to move to Schroders, was a strong sales and marketing effort so we could grow the fund. We have many different analysts and fund managers who work on the public side, And there's also Schroders Capital on the venture side. So we've got that whole cross spectrum of know-how that we can draw upon, which reflects what we invested in IBT. So from venture all the way up to mega cap companies, if we so please. So we've got that broad-based support, both in terms of sales and in experience on the fund management side. And also on a lower level, we have a big deal team in America, whereas at SV, we didn't have that sort of support. And then equally, we get access to all of the sell-side research, whereas in the past, we only really managed to get the middle tier input. So all of those factors have actually meant that our performance has improved markedly since we moved over to Schroders.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.